Hello and welcome to this edition of the video market update from Orbex.com. Last week we finally got some good news from the US, including the GDP data, which grew by 2.6% in Q2 of this year. Moreover, Q1 GDP has been revised even higher toward 1.4% instead of 0.7%. Yet, the US dollar index continued to decline further, reaching the lowest level since June of last year. One of the main reasons behind the US dollar decline is basically the Federal Reserve's latest statement. The Federal Reserve decided to leave the current policy unchanged as widely expected. However, the Federal Reserve also decided not to mention September or even December potential rate hikes. However, what matters the most in the Federal Reserve or the Federal Reserve statement is that the Fed has removed the sentence about trimming its balance sheet later this year and decided to replace it with a word or with a sentence that relatively soon. This means that the Federal Reserve has doubts over trimming its balance sheet later this year and might even think about it or rethink about it later next year. Moreover, the Fed Fund Futures is now basically pricing in a 45% chance for one more rate hike later this year, and in return, the US dollar index also tumbled below the 93.50s, reaching the lowest level or as low as 93.20s, with a weekly close below or around the 93.25. Monday is the last trading day of the month, and the US dollar index is likely to close the month lower, which means that the US dollar index will complete 5 months of consecutive declines, one we have not seen since 2011, which also deepened its bearish outlook. As for the week ahead, there are many economic figures will be released, which is likely to have no major impact on the market, especially in the US. First of all, on Monday, we will be waiting for the manufacturing and the non-manufacturing PMIs from China, while the European session is likely to be very significant as we wait for the inflation data from Europe, while at the same time we will be waiting for the Chicago PMI and the pending home sales during the US session. On Tuesday, eyes will be on the RBA decision, or the Reserve Bank of Australia, during the Asian session, which is likely to keep the current policy unchanged, but at the same time, a dovish tone is more likely, especially with the Aussie is now at the highest level since May of 2015. In Europe, we will be watching also manufacturing PMI from the UK and the flash GDP for the Eurozone, while we wait also for the personal spending, personal income, core PCE price index, and the ISM manufacturing PMI also from the US or during the US session on that day. Wednesday will be very interesting as we will be waiting for the jobs report from New Zealand during the Asian session, followed by the jobs report in Spain during the European session, but side by side with the UK construction PMI. And finally, eyes will be of course on the ADP non-farm employment change and the US crude oil inventories during the US session. On Thursday, all eyes will be on the Bank of England decision with the possibility for a surprise vote, and most likely there will be more than 3 members might vote to increase the official bank rate as inflation remains higher. Finally, on Friday, it's basically the US jobs report day, which will give us more clues and more signs on whether the US economy is indeed slowing down according to the numbers, or that the recent slowing down that we saw in many of the data is basically temporary or for a short period of time. This is it for the fundamental part of this video. Now, let's have a look at some technical charts. Beginning with the US dollar index as always, and again, the chart continued to speak for itself. Last week we had another leg lower below the 95.50, below the 95, below the 94.50s even, and continued all the way down below the 94 and below 93.50s, closing the week around the 93.25. However, this is still a continuous bearish outlook on most of the time frames, whether the daily, the weekly, and the monthly chart. Most of the technical indicators are also lower. The 200-day, the 100-day, and the 50-day are now like below the 200-day moving average, which keeps the bearish outlook unchanged. At the same time, the 200-day moving average started to turn lower, which deepened the current bearish outlook. Last week on Thursday, when we had a spike in the US dollar index, it was just only for a very short period of time, which gave some relief to the technical indicators as shown here before actually or after they have been heavily oversold. This is still a possibility for another leg lower in the next few days. However, On the weekly chart, we would like you traders to keep an eye on a very significant support area, which basically stands between the 93 and the 91.80. Why? Because this level or this area has been supporting the US dollar index since almost 2015, or especially since May of 2015. We saw like the test many times, and since then the US dollar index has been going up. But now we have the test of the 93 in the next few days. This is highly possible, but at the same time, this area might be the area where the short-term retracement might occur, especially if it breaks or if it holds above the 93 or above the 91.80s. Any break or any weekly close below this area would clear the way for faster declines ahead, which might be supported by the Federal Reserve decisions in the next few weeks, also in September, in the next few months, or even in December. As long as the market continues to believe that the Federal Reserve will not be able to do that, or to raise the rates, or even to trim its balance sheet, this would clear the way for further declines in the US dollar. Going forward to our technical charts, and starting with the Kiwi. The Kiwi also continues to rise for the third week in a row. Now we are trading above the 200-week moving average for the first time since February or even August of 2014. This is very significant as we wait also for the Reserve Bank of Australia later this week. But before going to the jobs report also in New Zealand, for the time being, the outlook is basically switched into strongly bullish, but at the same time, technical indicators are heavily overbought, which means that we need at least a slight retracement to the downside before any kind of move like to the upside or continuation to the upside. At the same time, the downside retracement is likely to be limited whether above the 200-week moving average, which also stands at 74.30s, or above the breakout point or the breakout level, which was around the 73.30s. As long as it stays above those two levels, the next spike higher is likely to come in the next few days or the next few weeks, to where we will be looking for another leg higher, possibly first of all toward the 75.95 or 76, and the next level would be the next resistance, which is around, we're talking about 77.13. Going forward also to the Aussie. The Aussie has the same story, but the Aussie was able actually to fail to break above the 200-week moving average on the weekly chart. That's number one. Number two, also this was also the same resistance area, which is the 80.41. At the same time, the 80 is a psychological resistance that everybody should keep an eye on. We wait for the RBA decision later this week, which is going to be very important because we believe that the Reserve Bank of Australia might intervene somehow verbally to put the pressure on the Aussie once again, especially that the technical indicators are heavily overbought. At the same time, the Reserve Bank of Australia doesn't want to see the Aussie around these levels, especially that right now we tested the 200-week moving average for the first time since almost, we're talking about March of 2013. This is very positive. This is very significant. So keep an eye on the Aussie. Any retracement is likely to be also limited above the 77.20s. Going forward to the Euro. The Euro continues to rise again, and right now this is also very significant, especially that the Euro is now above the 2015 highs. Now it's the highest level since December of 2014, or January 2015, and above a weekly close above the 17. This is very significant also. This continues to show that the Euro is very strong, and for the next few days, traders need to keep an eye on the 17 as a support area, but on the upside there is still a possibility to test for the next few days around the 118.60s is in view, with again a limited support or limited downside with a limited downside retracement. The British pound is also regained above the 131 again as the US dollar index continues to decline. It is actually, it's a dollar weakness more than as if it's a sterling strength. This week we'll be watching also the next few levels, which is the same levels as last week. Now We're above the 31.11. Now we will be looking toward the 31.90, and a break above that resistance would clear the way toward the 33.80. This might be supported by the Bank of England decision that we'll be waiting on in the next few days, especially if the votes come in with a surprise, or with more than 3 members voting to raise the rates. The dollar yen continues also to slide, continuing also toward one of our target, which was the 110.72, as mentioned in our previous video. Now we have a clear break below the 1070 support area. This would clear the way toward 110 and 109.95 as the next support area. At the same time, I'll be looking for another leg lower, possibly toward 109.60s, and also at the same time 109.40s. That will be the next levels to watch, with also with a stop, if any kind of stop it would be, or any retracement is likely to be limited below the 200-day moving average, which stands about 112.08. Finally, gold and silver. Gold continues to prove itself again, and we actually broke above the 61.8% retracement, the one that I was afraid from last week at 1261. Now we're 1269 with a weekly close, a clear weekly close above the 61.8. This would actually clear the way for further gains ahead, at least toward the 89. At this is the first level to watch, and then hopefully we will be testing the 1300, or a break above that resistance would clear the way for another spike higher. Any retracement is likely to be very limited and likely to be above the 1251, which is also the 50 and 100-day moving average, and also complemented by slightly the trend line support. Silver also continued to prove itself, but at the same time, I'm still afraid from silver a little bit, because we tried to break above the 50-day moving average, but at the same time we had a bearish shooting star on Thursday. Friday it managed to break above that resistance, but at the same time now we have the make it or break it level, which is the 1670s, as it's the daily trend line. A break above that resistance, I still need to see silver above the 1715, which is the 200 and the 100-day moving average, in order to give us more signs that the silver will be able to break even higher. Until then, keep an eye on these levels, otherwise there will be still a risk for another leg lower, possibly toward the 1611 or the 1610 as a retest. This is it for the week. Thank you for watching this week's video. Please like and share this video on social media platforms, and also subscribe to Orbex, Orbex.com channel on YouTube to get the latest videos on time. If you have, of course, as always, any questions, please leave them below under this video on YouTube, and I'll try to get back to them as soon as possible. I'll see you once again next week. Have a good day.